Welcome to the Explainer. Let me ask you something right out of the gate. Have you ever stared at a price chart and just felt like the market is completely random? Like you're constantly just reacting to chaos, getting stopped out literally right before a massive move in the exact direction you predicted? Look, I completely get that frustration. Most retail traders feel exactly that way. But the professionals? Oh, they know better. Today, we're actually going back over 100 years to unpack the Wyckoff Method. Developed by Richard Wyckoff in the early 20th century, this isn't just some run-of-the-mill trading strategy. It's a deeply logical framework that lets you see the market's hidden footprints. It is, without a doubt, the professional's ultimate edge. Here's our agenda for today. First, we'll meet the composite operator. 2, the 3 fundamental laws. 3, the 4 stages of the cycle. 4, springs and upthrusts. 5, volume analysis. And finally, 6, the disciplined mindset. Section 1. Meet the composite operator, uncovering the hidden game. To truly understand how to trade profitably, we need a massive paradigm shift. You've got to stop viewing the market as random. Does it feel like a total guessing game to you? Because if it does, you're likely trading like a retail participant, just reacting to the noise. You see, the game has already started way before you even notice a trend on your chart. By the time the news is breaking and the hype is hitting its absolute peak, the real players, they're already planning their exit. To explain this, Wyckoff came up with a genuinely brilliant concept. Meet the composite operator. Now, this is a metaphor for the combined force of large institutional players, what we often call the smart money. I want you to imagine them as one single, highly coordinated entity, acting deliberately and, sometimes deceptively to buy up massive amounts of assets at dirt cheap prices and then sell them right back to you a top dollar. Now, our goal with this explainer isn't to figure out how to fight this giant. Our goal is to learn how to read its footprint so we can trade in complete harmony with it. Section 2, 3 fundamental laws, the logic of the market. Wyckoff didn't use any magic indicators. He relied on 3 fundamental, deeply logical laws that dictate market intent. First up is the law of supply and demand. This is just basic economics, right? When demand is greater than supply, prices go up. When supply exceeds demand, prices fall. Second is the law of cause and effect. See, market trends don't just happen by accident. They require a long period of sideways preparation, which is the cause, to produce the resulting trend, which is the effect. And third, the law of effort versus result. Here, effort is represented by trading volume, and the result is the actual price progress. Those two need to align for a trend to be considered healthy. There's a saying that perfectly captures this law of cause and effect. The longer the base, the higher the space. It's a super catchy phrase that professional traders use to remind themselves that a massive, prolonged sideways accumulation range, the base, it stores up incredible energy. So when that breakout finally happens, the resulting uptrend, the space, is going to be absolutely explosive. Section 3, 4 stages of the cycle, predictable market phases. Now that we've got the laws down, let's map out exactly what this looks like on a real chart. Markets do not move in a straight line. They move in this cyclical, highly predictable rhythm. Think of this as the life cycle for pretty much any traded asset. Phase 1 is accumulation. That naturally transitions into phase 2, the markup. Then we hit phase 3, distribution, which ultimately crashes down into phase 4, the markdown. And once that markdown exhausts itself, the whole cycle just begins all over again. Let's break down the actual mechanics of these stages step by step. In step 1, accumulation, honestly, it's boring. The market is just chopping sideways. The news is probably terrible, but smart money is quietly absorbing all the available supply. Once that supply is totally dried up, step 2 kicks in, the markup. This is your classic uptrend, where demand easily overcomes whatever supply is left. Then, as retail traders flood in out of pure FOMO, we hit step 3, distribution. The smart money uses all that euphoric liquidity to quietly sell off their positions. And finally, step 4, markdown. The buying dries up, fear takes over, and the market plummets until all those weak hands are totally shaken out. Section 4, springs and upthrusts, the traps. If you actually want to survive this cycle, you have to understand the traps. Let's zoom in on the most treacherous parts of these sideways ranges, which is exactly where retail traders get slaughtered and smart money fills up their bags. Wyckoff actually tracked 7 specific logical events that happen within any trading range. But for the sake of our explainer today, we're just going to zero in on the absolute most critical one, the moment of maximum manipulation. Let's contrast the 2 ultimate traps. First, we have the spring, which happens during accumulation. Price suddenly drops below a major support level. Retail traders totally panic, their stop losses get triggered, and they sell. But who's buying all that? the Composite Operator. It is a classic bear trap. Then, on the flip side, is the Upthrust, which happens during distribution. Price breaks out above resistance. Retail traders scream moon and buy in aggressively. But the smart money is actually just unloading their final shares straight into that massive buying pressure. It's a bull trap, and the price is going to collapse shortly after. I literally cannot stress this enough. Identifying a real spring or upthrust is a total game changer for your profitability because it catches the exact moment the cause transitions into the effect. When you learn how to spot these false breakouts, you stop acting as the liquidity for the institutions, and you actually start entering trades right alongside them, getting an incredible risk-to-reward ratio. Section 5. Volume Analysis, the footprints of smart money. But you're probably wondering, how do you actually know if a breakout is real or just a trap? Well, that brings us right back to Wyckoff's law of effort versus results. We have to look at volume. Volume is the soul of the move. It's the undeniable footprint of the smart money. Let's compare two key scenarios here. First is harmony. If price breaks out and the volume is absolutely massive, effort and results are perfectly aligned. That huge volume means the big players are aggressively pushing the market. It's legitimate. But then we have divergence. If price breaks a key level but the volume is incredibly low, it's a fake out. There's no real effort behind the results, and that is a massive warning sign of an impending reversal, like an upthrust or a spring. Understanding these volume signals is basically your cheat sheet for reading the market's hidden health. When you see ultra-high volume on a major price breakout, that is true institutional intent. It's generally safe to follow. When the price pulls back during a trend on very low volume, that's actually great. It means there's no massive selling pressure, it's just a healthy trend confirmation. But you really need to pay attention to that bottom scenario. If you see high volume but the price is barely moving, just stuck in a tight, narrow range, that means a massive battle is happening. Someone big is absorbing all the orders, and a major reversal could be right around the corner. Section 6. The disciplined mindset. Putting it into practice. So we've got the theory, we know the laws, and we know how to track the footprints. Now we have to actually put it all into practice. And I want you to take this rule to heart. The Wyckoff Method is not some magical, rigid formula. Real markets are messy. They're highly flexible. If you sit around waiting for the exact, textbook-perfect diagram to form line by line on your chart, you're going to be paralyzed. You need to train your eye to look for the underlying intent, the absorption, the testing, the traps, rather than looking for perfect geometric shapes. To summarize everything we've covered in this explainer, here's your action plan. First, always zoom out and identify the current market phase. Are we in a markup, or are we just stuck in a long accumulation? Second, patience is literally your greatest weapon. You have to wait for that spring or upthrust to trap the impatient traders. Third, always verify the market's intent using volume analysis. And finally, use Wyckoff in harmony with your other tools, like candlestick patterns or moving averages, to really time your entries perfectly. Which brings us to our final thought for today. I want you to really ask yourself, are you just reacting to the crowd, chasing green candles out of FOMO and selling in a total panic? Or are you analyzing the cause, reading the volume, and planning your trades exactly like the Composite Operator? It is time to stop acting as prey. Start trading in harmony with the logic of the smart money. Thanks for joining me on this explainer, and happy